There is a promise whispered in the noise of the financial world, a seductive myth that fuels an entire industry of cable news shows, online forums, and late-night infomercials. It's the promise of the single life-changing tip, the one stock, the one secret, the one piece of forbidden knowledge that will catapult you from your current reality into a new world of effortless wealth. It's the idea that financial freedom is just one clever decision away, a lottery ticket disguised as an investment. And for decades, the undisputed king of investing, Warren Buffett, has been the unwilling icon for this myth. People hang on his every word, not for the deep wisdom he offers, but for the ticker symbol he might accidentally let slip. They want the fish. They don't want the lesson on how to fish. But the great irony, the profound and often ignored truth of Warren Buffett's entire life and career, is that his single greatest investment, the one with the highest, most incalculable return on investment, is not a stock. It has never been a stock. It isn't Coca-Cola, or American Express, or See's Candies. It's an investment he made as a young, ambitious man in Omaha, Nebraska, and it's one he continues to compound every single day. And in uncovering the nature of this supreme investment, we unravel the myth of the hot tip and replace it with a blueprint for genuine, unshakable, lifelong wealth. The core principle is this: the most important investment you can ever make is in yourself. It is the dedicated, unending process of building your own knowledge. This isn't a platitude. It is the single most important strategy for preventing the most common and costly mistake in the market: dabbling. Dabbling in stocks, in crypto, in any asset class, without first investing the time to build a foundation of fundamental knowledge, is a guaranteed path to financial ruin. It's the act of walking onto a battlefield with a blindfold on, armed only with rumors and hope. The financial transformation that this principle ignites is the commitment to becoming a lifelong learning machine. It is the profound understanding that the more you learn, the more you earn. Not in a linear fashion, but with a powerful compounding effect, where each new piece of knowledge connects with the old, building a latticework of wisdom in your mind that pays you dividends in every decision you make for the rest of your life. This is not about a stock. This is about the engine that powers every successful investment decision. This is the story of Buffett's final promise, that the greatest fortune you will ever build is the one between your ears. The journey to understanding this begins not in a bustling boardroom or on the floor of the New York Stock Exchange, but in the quiet, dusty archives of a university library. This is the first pillar of Buffett's philosophy, the invisible asset, the absolute, non-negotiable mandate to build your intellectual capital before you ever risk your financial capital. It's a principle forged in his youth, a foundational habit that would become the bedrock of his entire empire. To truly grasp its power, we must go back to the early 1950s. Warren Buffett was a young graduate student at Columbia Business School, a disciple of the legendary Benjamin Graham, the father of value investing. While other young men his age were chasing parties and fast cars, Buffett was chasing information. He developed an obsession, a voracious, insatiable appetite for the raw data of business. He would later recall that he had read every book on investing in the Omaha Public Library by the time he was 11, but at Columbia his quest reached a new level of intensity. His real education took place in the library, specifically with a set of dense, intimidating volumes that would have put any normal person to sleep, the Moody's Manuals. These were encyclopedic tomes, thousands of pages of fine print, detailing the financial histories of virtually every publicly traded company in America. To most, they were impenetrable walls of numbers. To Buffett, they were treasure maps. He would spend countless hours, day after day, manually turning the pages, absorbing the stories told by the balance sheets and income statements. He wasn't looking for a hot tip. He was looking for a pattern. He was downloading the entire history of American business into his brain, one page at a time. It was during one of these deep dives into the Moody's Insurance Manual that he stumbled upon a small, obscure company called the Government Employees Insurance Company, or GEICO. It wasn't a household name, it wasn't a Wall Street darling, but as Buffett read the report, something clicked. He saw a business model of breathtaking elegance. Geico sold auto insurance directly to a low-risk pool of federal, state, and municipal government employees, bypassing the traditional agent system. This created a massive cost advantage, which they passed on to their customers in the form of lower premiums, creating a virtuous cycle of growth. The numbers didn't just suggest a good company, they screamed of a financial fortress with a durable competitive advantage. This discovery ignited a fire in him. On a Saturday, he took a train from New York down to Washington, D.C., and banged on the door of Geico's headquarters until a janitor let him in. He eventually found a high-level executive, Lorimer Davy Davidson, who was working that weekend. For the next 4 hours, the young, unknown student grilled the seasoned executive about every facet of the insurance business. Buffett returned to New York not just with an investment idea, but with a deep, fundamental understanding of the industry. He put more than half of his entire net worth at the time, about $10,000, into Geico stock. He had built his intellectual capital first. He had done the grueling, unglamorous work of reading the manuals and understanding the business model before he risked a single dollar of his financial capital. The investment was a staggering success. But the real lesson, the one that would shape the next 70 years of his life, was not in the profit he made. It was in the process. The power wasn't in finding Geico. The power was in becoming the kind of person who could find Geico. That power was forged in the library, page by painstaking page. He had built an invisible asset, a deep reservoir of knowledge that was infinitely more valuable than the stock itself. The underlying psychological principle at play here, the cognitive trap that Buffett's approach systematically dismantles, is one of the most pervasive and dangerous biases in all of human decision-making, the Dunning-Kruger effect. Coined by psychologists David Dunning and Justin Kruger in 1999, this principle describes a fascinating and terrifying quirk of the human mind. The less competent you are at something, the less able you are to recognize your own incompetence. In fact, not only do people with low ability fail to recognize their own lack of skill, they are also more likely to feel a sense of illusory superiority, rating their own ability as much higher than it actually is. It's the bias of the enthusiastic amateur, the curse of the beginner who doesn't know what they don't know. In the world of investing, the Dunning-Kruger effect is a weapon of mass financial destruction. A new retail investor opens a brokerage account. They read a few articles, watch a few videos, and hear about a stock that's going to the moon. They place their first trade, and by sheer luck it goes up. The brain is flooded with dopamine. The thought process isn't "I got lucky," it's "I'm a natural at this. This is easy." This is the peak of what Dunning and Kruger called Mount Stupid. The investor, armed with a tiny sliver of knowledge and a mountain of unearned confidence, believes they have cracked the code. They start making bigger bets, wading into complex financial instruments like options or leveraged ETFs that they don't remotely understand. They mistake the random noise of the market for a signal that confirms their genius, and then, inevitably, the market does what the market always does. It humbles you. The bubble pops, the trend reverses, and the overconfident amateur is wiped out. Their confidence shatters, and they plummet into the valley of despair, often concluding that the market is just a rigged casino and swearing off investing for good. They blame the game, not their own lack of preparation. Warren Buffett's lifelong habit of deep, immersive learning is a direct antidote to this deadly cognitive bias. His process is built on a foundation of profound intellectual humility. By spending thousands of hours reading financial statements and business histories, he was not just accumulating facts, he was mapping the vast territory of his own ignorance. Every page he turned revealed more of what he didn't know. The more he learned about the insurance industry, for example, the more he understood its complexities, the nuances of underwriting, the management of float, the catastrophic risks. This deep knowledge didn't make him more arrogant. It made him more cautious, more aware of the potential pitfalls. It kept him firmly off Mount Stupid. The Dunning-Kruger effect thrives in an information vacuum. Buffett's strategy is to flood that vacuum with so much data, so much history, so much fundamental knowledge that overconfidence has no room to grow. He understands that true confidence in an investment decision doesn't come from a market trend or a positive news story. It comes from having done the homework so thoroughly that you understand the business better than almost anyone else. It's the difference between the gambler's bravado and the scholar's quiet conviction. This psychological principle is the invisible barrier that separates smart money from the masses. The 99% are driven by ego and the seductive illusion of easy competence. Buffett is driven by a humble, relentless quest for genuine understanding, knowing that in the long run, the market is a brutal and efficient grader of homework. So how can we translate this from a story about a young genius in the 1950s into a practical, actionable blueprint for our own lives? We need an applied mental model, a step-by-step process. We can call it the knowledge first, capital second protocol. This is the manual for building your invisible asset, your intellectual capital, before you expose your financial capital to the risks of the open market. It's a system designed for the stock market, for beginners, for entrepreneurs, for anyone serious about building wealth, and it is the first step toward developing a true CEO mindset. Step 1 is the hardest, but it is the most crucial. Declare a moratorium. If you are new to investing or have been struggling, you must freeze all new market activity. Stop buying, stop selling, stop checking the ticker every 5 minutes. You are stepping off the chaotic battlefield to go to officer training school. Your portfolio is not your priority right now, your brain is. This act removes the emotional volatility of daily market swings from your decision-making process, allowing you to learn with a clear, unbiased mind. Step 2 is to define your curriculum. You wouldn't try to build a house without a blueprint, and you cannot build financial knowledge without a structured learning plan. Don't just wander aimlessly through the internet. Create a foundational reading list. Start with the undisputed classics. Benjamin Graham's The Intelligent Investor, especially the chapters on Mr. Market and the Margin of Safety, is your Bible. Peter Lynch's One Up on Wall Street will teach you how to use your own everyday experience to find investment ideas. Pat Dorsey's The Little Book That Builds Wealth will give you a rock-solid understanding of economic moats, the durable competitive advantages that Buffett cherishes. This isn't about speed reading. It's about deep comprehension. This curriculum is the start of your real financial education. Step 3 is to schedule the work. Lifelong learning isn't something that happens when you find the time. It happens when you make the time. You must schedule your learning like you would a critical business meeting. Commit to a non-negotiable block of time each day. It could be 1 hour in the morning before the world wakes up, or 45 minutes during your lunch break. The key is consistency. As Buffett says, the chains of habit are too light to be felt until they are too heavy to be broken. You are forging the habit of learning. During this time, there are no distractions. No phone, no social media, no television. It is just you, the material, and your thoughts. Step 4 is to engage with the material actively, not passively. This means starting a learning journal or a simple document. For every chapter you read, you must write a short summary in your own words. What was the core idea? How does it connect to what you've learned before? How would you explain this concept to a 10-year-old? This simple act of retrieval and synthesis is what transfers knowledge from short-term memory to long-term understanding. It forces you to wrestle with the ideas, not just consume them. This journal becomes your personal repository of financial wisdom, a reference guide you built yourself. Step 5 is the capstone of this initial phase. Only after a minimum of 90 days of consistently following these first 4 steps should you even consider deploying new capital. And when you do, it should be a small, experimental amount. Your first task is not to make a profit, but to apply your new knowledge. Take one company you're interested in and read its latest annual report, the 10K. Try to identify its business model, its revenue streams, its competitive advantages, and its potential risks using the frameworks you've learned from your reading. This protocol systematically transforms you from a gambler into a student and eventually into an analyst. It ensures that by the time you place your first real, significant trade, it is not a hopeful punt based on a tip from a friend. It is the final logical step in a rigorous process of intellectual due diligence. You will have built the foundation first. You will have earned the right to invest. To fully appreciate the power of this protocol, we must dedicate some time to exploring its antithesis, the path of the 99%. This is the world of the dabbler, the speculator, the hot tip chaser. It is a world governed not by logic and process, but by emotion, social pressure, and a desperate desire for a shortcut. The archetype of this path is a person we can call Reactive Rick. Rick's financial education comes from a scattered mosaic of unreliable sources. He gets his stock picks from a charismatic YouTuber, a frantic host on a cable finance show, or a hyped-up thread on a Reddit forum. His investment thesis is not based on balance sheets or competitive advantages. It's based on a compelling story, a fear of missing out, or the vague promise of a disruptive technology he doesn't truly understand. His journey begins with a surge of excitement. A stock, let's call it Future Corp, is all anyone is talking about. It's the next big thing. The stock chart is a beautiful, near vertical line. Rick experiences a powerful wave of FOMO, the fear of missing out. Every day he waits, he feels like he's losing money. He doesn't read the company's 10K. He reads tweets about the company's visionary CEO. He doesn't analyze its cash flow. He analyzes the sentiment in a Discord channel. Finally, he can't take it anymore. He wires a significant chunk of his savings into his brokerage account and buys Future Corp at its all-time high. For a week, he is a genius. The stock continues to climb. He checks his account a dozen times a day, each green flicker a hit of dopamine, reinforcing his decision. He's cracked the code. He mentally starts spending his future profits, a down payment on a house, a new car, quitting the job he hates. This is the peak of Mount Stupid. Then the inevitable correction comes. A critical news story, a missed earnings report, or just a shift in broad market sentiment. The stock drops 10%. Rick tells himself it's just a dip, a buying opportunity. It drops another 20%. The confidence starts to crack, replaced by a knot of anxiety in his stomach. The forums that were once filled with rocket ship emojis are now filled with angry accusations and panicked theories. His dopamine hits are replaced by cortisol spikes. He starts selling his other, more stable investments to average down on Future Corp, a classic case of throwing good money after bad. Finally, when the stock is down 70% from its peak, the pain becomes unbearable. The psychological principle of loss aversion kicks in with crushing force. The fear of losing everything overwhelms any rational thought of long-term recovery. He sells everything at a catastrophic loss, locking in his failure. His financial transformation is the opposite of the one Buffett promises. He is left with a depleted savings account and a deep-seated belief that investing is a rigged game for suckers. He has not only lost his money, he has lost his confidence and his opportunity to build real wealth over time. The fundamental difference between Reactive Rick and Warren Buffett is not intelligence. It is process. Rick sought a shortcut, a fish. Buffett committed to the long, arduous process of learning how to fish. Rick outsourced his thinking to the crowd. Buffett insisted on doing his own work. Rick's journey was a chaotic, emotional roller coaster destined to crash. Buffett's is a calm, disciplined, and cumulative climb. This path of the 99% is not just a less effective strategy. It's a wealth destruction machine powered by the most predictable and potent of human emotions. The direct financial connection between Buffett's learn first principle and tangible results is not just about picking winners, it's far more profound. It manifests directly on the balance sheet of your life in three critical ways: catastrophic loss avoidance, the creation of a personal knowledge moat, and the dramatic reduction of frictional costs. Firstly, and most importantly, is the concept of catastrophic loss avoidance. In the mathematics of compounding, a large loss is exponentially more damaging than a missed gain. If you have a $100,000 portfolio and it drops by 50%, you have $50,000. To get back to your starting point, you don't need a 50% gain. You need a 100% gain, which is far more difficult to achieve. The dabbler, the reactive Rick, is constantly exposed to these portfolio-crippling losses because they are investing in things they don't understand. Buffett's deep learning process is, first and foremost, a risk management tool. By refusing to invest outside of his circle of competence, he systematically eliminates the biggest risks, the ones that come from ignorance. The financial value of the losses you don't take over a 30-year investing career is arguably the single largest contributor to your final net worth. This return on avoided mistakes is a silent, invisible force that pads your portfolio year after year. Secondly, building your intellectual capital creates a personal knowledge moat. In business, a moat is a durable competitive advantage that protects a company from competitors. For an individual investor, your unique, deeply researched understanding of a particular industry or company is your moat. While the rest of the market is reacting to headlines about interest rates or geopolitical events, you are focused on the long-term fundamentals of the businesses you own. This allows you to act rationally when others are panicking. When a great company's stock price drops due to a temporary, market-wide scare, your deep knowledge gives you the confidence to buy more, not sell. This is what Buffett did during the 2008 financial crisis, investing in solid American institutions when everyone else was fleeing in terror. This knowledge moat turns market volatility from a source of fear into a source of opportunity, directly translating into higher long-term capital gains. Finally, the learn-first approach dramatically reduces the frictional costs that bleed most retail investor accounts dry. Dabblers are constantly trading, chasing the next hot thing. Every trade incurs costs, commissions, bid-ask spreads, and, most significantly, taxes. Short-term capital gains are taxed at a much higher rate than long-term gains. This constant churn is like trying to fill a bucket with a hole in it. The Buffett approach, born from deep study and conviction, leads to a low-turnover, long-term portfolio. You buy great businesses that you understand and you hold them, allowing them to compound wealth for you with minimal tax drag. The money saved on taxes and trading fees alone can amount to tens or even hundreds of thousands of dollars over an investment lifetime. In essence, the financial connection is this: the 99% focus on trying to grow their financial capital directly, and in their ignorance, they often destroy it. The Buffett model focuses on growing intellectual capital first. This intellectual capital then acts as a shield, protecting the financial capital from stupid mistakes, and as a sword, allowing it to strike with conviction when rare opportunities appear. The investment in learning doesn't just show up in your portfolio's growth. It shows up in its resilience, its tax efficiency, and its ability to turn the market's madness to your advantage. The second great pillar of Buffett's philosophy builds directly upon the first. It's not enough to commit to learning. One must have a system for how to learn effectively. This pillar is the 500-page rule, forging your mind into a compounding machine. This isn't just about the sheer volume of reading. It's about a specific methodology of consumption and contemplation that turns raw information into usable wisdom. The rule itself stems from a now famous answer Buffett gave to a group of students. When asked how to prepare for an investing career, he gestured to a stack of reports and manuals and said, "Read 500 pages like this every day. That's how knowledge works. It builds up, like compound interest. All of you can do it, but I guarantee not many of you will do it." This anecdote, while powerful, often gets misinterpreted. People focus on the daunting number, 500, and miss the more profound message about the process of how knowledge compounds. The story that truly illuminates this pillar is not just the quote, but the living reality of his daily routine. For decades, Buffett's workday has been a testament to this principle. He arrives at his modest office in Omaha, and, by his own estimation, spends up to 80% of his day simply reading and thinking. There is no phalanx of monitors flashing stock quotes. There isn't a bustling trading floor. For many years, he didn't even have a computer on his desk. His primary tools are books, annual reports, industry journals, and newspapers. The crucial element is not just the reading, but the vast, silent stretches of time he dedicates to thinking about what he has read. He creates an environment of deliberate solitude, free from the constant influx of emails, meetings, and notifications that fragment the attention of the modern executive. A perfect illustration of this method in action was his 1973 investment in the Washington Post Company. At the time, newspaper stocks were deeply out of favor. Wall Street saw them as dinosaurs, threatened by the rise of television. The consensus was negative, but Buffett didn't listen to the consensus. He engaged in his deep learning process. He read the annual reports of the Post and dozens of its competitors. He went back decades, analyzing their financial performance through different economic cycles. He realized that a dominant city newspaper was what he would later call a natural franchise, a business with a powerful, durable economic moat. It was the central hub for local advertising, jobs, and real estate listings. This dominance gave it immense pricing power. While Wall Street saw an old media company, Buffett, through his deep reading and focused thinking, saw an unregulated, cash-gushing toll bridge. He invested over $10 million, a huge sum for his partnership at the time, buying a significant stake in the company. The investment became one of the most successful in his career, eventually growing to be worth over 100 times his initial purchase price. That monumental return wasn't generated by a computer algorithm or a secret source. It was generated by a man sitting alone in a room, reading and thinking more deeply than anyone else. He wasn't just processing words on a page. He was connecting dots across industries and decades, building a complex mental model of the newspaper business that was invisible to the hurried, headline-driven analysts on Wall Street. The 500-page rule isn't a prescription for speed reading. It is a prescription for a life of deep work, for creating the mental space necessary for knowledge to not just be acquired but to marinate, connect, and compound into true wisdom. The psychological principle that makes the 500-page rule so potent is rooted in the science of how our brains build expertise. It's a combination of creating desirable difficulties and leveraging the brain's capacity for pattern recognition, a stark contrast to the shallow, fragmented way most people consume information today. Modern life trains us for distraction. Our brains are constantly being rewired by a barrage of notifications, headlines, and short-form content. This creates a state of continuous partial attention. We skim, we scroll, we hyperlink hop. This type of information consumption is like trying to nourish a plant with a light misting. The water evaporates on the surface and never reaches the roots. Deep reading, the kind Buffett practices, is a form of cognitive heavy lifting. It is a desirable difficulty. It forces the brain to focus on a single, complex topic for an extended period. This sustained focus is what neuroscientists believe is necessary to move information from our fleeting working memory into our long-term memory. It's the process that builds and myelinates neural pathways, effectively hardwiring knowledge into the physical structure of our brain. It is the mental equivalent of a bodybuilder progressively adding more weight to the bar. The struggle is what triggers the growth. Furthermore, Buffett's method is not just about memorizing facts. It's about building a latticework of mental models. By reading broadly across annual reports, biographies, and industry histories, he is feeding his brain a rich and varied diet of patterns. The human brain is, at its core, a pattern recognition machine. When you read the history of the railroad industry, you learn about network effects and capital allocation cycles. When you read about the rise and fall of a retail giant, you learn about brand loyalty and the dangers of changing consumer tastes. When you then pick up the annual report of a new company, your brain doesn't see it in isolation. It instinctively starts to search for patterns. Is this business like the railroads of the 1890s? Does it have the brand power of Coca-Cola in the 1980s? This cross-referencing of models from a vast mental library is what allows him to achieve a level of insight that is simply impossible for someone who has only a superficial, surface-level understanding. The shallow information consumer sees a stock. The deep reader sees a business with historical parallels, competitive dynamics, and psychological underpinnings. This process actively combats cognitive biases like recency bias, the tendency to give too much weight to the latest information. Someone who only reads today's headlines might panic and sell a railroad stock because of a bad quarterly report on shipping volume. Buffett, with his deep historical knowledge, understands that these are cyclical businesses and that short-term fluctuations are often just noise. His long-term perspective, built over countless hours of reading, provides the emotional ballast to ride out the market's storms. The 500-page rule is, therefore, a psychological training regimen. It rewires the brain for focus, builds a deep reservoir of patterns in long-term memory, and provides the context necessary to overcome the emotional biases that shipwreck the average investor. To apply this principle, we need a mental model that moves beyond the abstract idea of reading more. We can call this the personal MBA framework. It's a structured approach to self-directed financial education designed to turn you into a multidisciplinary business analyst, the exact kind of thinking that underpins the success of Berkshire Hathaway. This is a crucial element for anyone seeking self-improvement and personal development on the path to financial freedom. Step 1 is to identify your core disciplines. A great business investor is not just a stock picker. They are a generalist with deep knowledge across a range of essential subjects. Your curriculum should be built around at least 5 core pillars. First, accounting, the language of business. You must learn to read a balance sheet, income statement, and cash flow statement fluently. Robert Hagstrom's Warren Buffett accounting book is an excellent starting point. Second, finance and valuation. You need to understand concepts like discounted cash flow, return on invested capital, and margin of safety. Aswath Damodaran's work, much of which is available for free online, is the gold standard here. Third, business strategy. This is the study of competitive advantage, or moats. Michael Porter's Competitive Strategy is the seminal text. Fourth, psychology. You must understand the cognitive biases that affect you and the market. Daniel Kahneman's Thinking Fast and Slow and Robert Cialdini's Influence are non-negotiable. Fifth, management. You need to be able to assess the quality and integrity of a company's leadership. Lawrence Cunningham's The Essays of Warren Buffett provides a masterclass on this. Step 2 is to curate your resources and create a system for deep engagement. For each of the core disciplines, build a reading list. But don't just passively read. You must create a system for synthesis. One powerful method is the Feynman technique. After reading about a complex concept like float in the insurance business, open a blank page in a notebook and try to explain it in simple, plain English as if you were teaching it to someone else. If you get stuck or have to use jargon, you don't truly understand it yet. Go back to the source material until your explanation is clear and simple. This active recall process is what forges true comprehension. Step 3 is to schedule dedicated, sacred time for this work. This is the practical application of the 500-page rule. Put personal MBA time on your calendar. An hour a day is over 350 hours a year, more than enough to earn the equivalent of a specialized master's degree. This time must be defended ruthlessly from distractions. It is the single most important appointment you have. During this time, you are not a passive consumer of information. You are a scholar and an analyst in training. Step 4 is to bridge theory and practice. The final piece of this framework is to apply your learning immediately. After reading about accounting, pull up the 10K of a company like Apple or Microsoft and try to identify the key line items. After studying competitive strategy, analyze a company like Costco. What is its moat? How does it protect itself from Amazon? This act of immediate application is what makes the knowledge stick. It transforms abstract concepts into tangible, usable tools in your intellectual toolkit. The personal MBA framework is a rejection of passive, shallow learning. It is a commitment to a deep, structured, and active pursuit of wisdom. It's not about the quantity of books you finish, but the quality of understanding you build. It's a rigorous process, but it is this very rigor that forges a mind capable of independent thought, capable of seeing value where others see only noise, and ultimately, capable of achieving the kind of portfolio growth that seems impossible to the dabbler. The antithesis to this deep learning machine is a figure we see everywhere in our modern world, the information snacker. This is the path of the 99% in the information age. The information snacker's diet consists of headlines, tweets, sound bites, and 3-minute video summaries. They are perpetually in the know, but understand almost nothing. Their intellectual state is a mile wide and an inch deep. In the context of investing, this is a recipe for disaster. The snacker starts their day by scrolling through a financial news feed. They see a headline, "Analyst upgrades tech giant on AI prospects." Dopamine hit. They see another, "Fed chairman hints at interest rate hikes." Cortisol spike. They are on a constant emotional roller coaster, dictated by the news cycle. They feel informed because they have consumed a high volume of information bites, but they lack any of the context, history, or deep understanding required to interpret that information correctly. Let's trace the snacker's decision-making process. They hear a lot of buzz about electric vehicles. They don't read a book on the history of the auto industry or a deep analysis of battery technology. Instead, they watch a few flashy YouTube videos showcasing a new EV startup. They join a forum where the sentiment is overwhelmingly positive. They see the stock price has been rising. This collection of information snacks, recency bias, social proof, and positive momentum creates a compelling illusion of a smart investment. They buy the stock. The company then announces a delay in production, the snacker sees the headline, and their stomach drops. They have no deep knowledge of the company's manufacturing process or supply chain to assess the severity of the delay. They only have the headline and the sea of red in their brokerage account. Their shallow knowledge base provides no anchor in the storm of negative sentiment. All they know is that the story has changed from good to bad, so they sell, often at a loss. A few months later, the company resolves its issues and the stock soars to new highs. The snacker is left behind, bitter and confused. The fundamental flaw of the information snacker is that they mistake information for knowledge and knowledge for wisdom. Information is just raw data, the headline, the stock price. Knowledge is that data organized and understood in context, understanding that production delays are common for new manufacturers. Wisdom is the ability to use that knowledge to make sound, long-term judgments, tempered by an understanding of history and human psychology, recognizing that the market often overreacts to short-term bad news in innovative industries. The 500-page rule is a system for moving up this pyramid from information to wisdom. The path of the information snacker traps them at the bottom, endlessly churning through data bytes, always reacting, never anticipating, and consistently making pro-cyclical decisions that lead to buying high and selling low. They are a leaf in the wind of the market's daily narrative, while the deep reader is the tree, rooted in the solid ground of fundamental understanding. The direct financial connection of the 500-page rule is that it creates a persistent informational alpha. Alpha, in investment terms, is the return you generate above the market benchmark. It's a measure of skill. In a world where quantitative trading firms and high-frequency algorithms can exploit tiny pricing inefficiencies in milliseconds, the only remaining, sustainable edge for an individual investor is in long-term, qualitative judgment. This is precisely what deep reading cultivates. Let's make this tangible. Imagine two investors are analyzing a hypothetical pharmaceutical company. The information snacker reads the latest press release. PharmaCorp announces promising Phase 2 trial results for new drug. The stock jumps 15%. The snacker, seeing the good news and the price momentum, buys in. The deep reader, who has been following the personal MBA framework, does something different. Because of their study of finance and accounting, they read the company's 10K and realize it's burning through cash at an alarming rate and will likely need to issue more stock, diluting existing shareholders. Because of their self-directed study of the biotech industry, they know that promising Phase 2 results are still a long way from an approved revenue-generating drug with a high probability of failure in Phase 3. Because of their study of psychology, they recognize the current stock price as being driven by euphoria and hype, not by a rational assessment of probabilities. The deep reader concludes that the risk-reward profile is unfavorable and decides to pass. 6 months later, the drug fails its Phase 3 trial. The stock collapses 80%. The snacker loses a huge portion of their capital. The deep reader preserves theirs. The financial benefit was not in a profit made, but in a devastating loss avoided, all thanks to a superior analytical process born from deep learning. This informational alpha manifests in another crucial way, identifying value where others don't. By reading hundreds of annual reports, you develop an intuitive feel for what a good business looks like. You start to recognize the financial signatures of companies with strong competitive advantages, high returns on capital, consistent margins, and low capital requirements. When you find a small, overlooked company in an unglamorous industry that has these characteristics but is trading at a low valuation because it's not part of a hot narrative, you have found a potential gold mine. This is the classic Buffett approach. He finds See's Candies, a boring chocolate company, or Nebraska Furniture Mart, a single-store retailer, and recognizes the gold-plated economics that the trend-chasing information snackers on Wall Street completely ignore. This directly impacts your long-term capital gains. By buying these high-quality, undervalued businesses and holding them for years, your returns are not just driven by market beta, but by the genuine alpha generated from your superior analysis. You are beating the market not by being faster but by being smarter and more patient. The investment in time, the hours spent reading and thinking, translates directly into a financial return that is less volatile, more tax-efficient, and ultimately far greater than what can be achieved by skimming the surface of the news. Having established the necessity of learning and the method for deep learning, we arrive at the third pillar, which acts as the crucial filter for all incoming knowledge, the circle of competence. This is the art of knowing what you don't know. It is one of the most intellectually honest and financially potent concepts in the Buffett-Munger toolkit. It is a mental model that prioritizes the avoidance of stupidity over the pursuit of brilliance, recognizing that in the game of investing, that is often the surest path to victory. The most powerful and famous anecdote illustrating this principle is not an investment Buffett made, but a massive decade-long bull market he famously sat out, the tech bubble of the late 1990s. The context of the late 90s is crucial to understand. It was a time of unbridled euphoria. The internet was changing the world, and a new paradigm of economics had supposedly rendered old valuation metrics obsolete. Companies with no profits and sometimes no revenue were going public and achieving billion-dollar valuations overnight. Wall Street was a frantic party, and anyone who wasn't buying technology stocks was ridiculed as a dinosaur, a relic of a bygone era. And the chief dinosaur, in the eyes of many, was Warren Buffett. Berkshire Hathaway's portfolio was full of old economy stocks like Coca-Cola, Gillette, and insurance companies. He owned 0 tech stocks. He was openly mocked on the covers of major financial magazines. Barron's ran a now infamous cover story in 1999 titled, "What's Wrong, Warren?" The article suggested his value investing methods were dead and that he had lost his touch. The pressure to join the party must have been immense. His shareholders were watching their neighbors get rich on stocks like Pets.com, while Berkshire's stock was lagging the market. But Buffett remained completely unfazed. His explanation was simple, consistent, and profound. When asked why he wasn't investing in tech giants like Microsoft or Intel, he would calmly reply, "I have no idea what those companies will look like in 10 years. I just don't understand the technology and the competitive dynamics well enough." This was not a statement of ignorance, it was a statement of profound intellectual honesty. It was the strict application of the circle of competence. He wasn't saying these companies were bad investments, he was saying he did not know. He could not project with any reasonable degree of certainty what their cash flows would be a decade into the future, and if he couldn't do that, he couldn't value them. Therefore, they were outside his circle. In March of 2000, the party came to a screeching halt. The Nasdaq index, a proxy for the tech bubble, began a catastrophic collapse, ultimately losing nearly 80% of its value over the next 2 years. The new paradigm stocks were vaporized. Trillions of dollars of speculative wealth vanished, and Warren Buffett, the dinosaur, was proven to be the wisest man in the room. By having the discipline to stay within the boundaries of what he understood, he avoided the single greatest destruction of investor capital in a generation. The circle of competence was not a tool for finding the next big thing. It was a shield that protected him and his investors from the siren song of speculative mania. It was a victory won not by a brilliant move but by a brilliant and disciplined inaction. The underlying psychological principle that the circle of competence so effectively counters is a toxic cocktail of two of the most powerful human biases, overconfidence bias and confirmation bias. Overconfidence bias is the natural human tendency to overestimate our own knowledge and abilities. We believe we are better than average drivers, have a better than average sense of humor, and are better than average investors. This bias is amplified in bull markets. When everything is going up, it's easy to mistake luck for skill. An investor makes a few successful bets on industries they know little about, and their brain concludes, "I have a knack for this." This feeling of being an expert in everything is an incredibly dangerous illusion. It tempts us to venture further and further away from our core knowledge base, into territory where we are operating with a significant informational disadvantage. This is where confirmation bias comes in to compound the error. Confirmation bias is the tendency to search for, interpret, favor, and recall information that confirms or supports one's pre-existing beliefs or hypotheses. Once an investor filled with overconfidence decides that a particular biotech or crypto asset is a can't-miss opportunity, their brain unconsciously goes to work to protect that decision. They will actively seek out news articles, forum posts, and expert opinions that validate their choice. They will interpret ambiguous news in a positive light and dismiss or downplay any negative information as FUD, fear, uncertainty, and doubt. They are no longer a neutral analyst seeking truth. They are a lawyer building a case for a conclusion they have already reached. The circle of competence is a cognitive tool designed to short-circuit this entire process before it begins. It is an act of pre-commitment. It forces you to define, in a sober and rational moment, the precise boundaries of your expertise. You are drawing a line in the sand. Inside this line is the small handful of industries or business models that you have studied deeply and genuinely understand. Outside this line is the rest of the universe, which you explicitly label as "Here be dragons." By creating this bright line, you inoculate yourself against the temptations of overconfidence. When a hot opportunity appears in an area outside your circle, the predefined rule kicks in. The question is no longer, is this a good investment? The question becomes, is this inside my circle? If the answer is no, the analysis stops there. It doesn't matter how compelling the story is or how many other people are getting rich. The rule is the rule. This act of intellectual humility directly combats confirmation bias as well. Since you never make the initial commitment to invest in something you don't understand, the process of seeking out confirming evidence never begins. You remain a detached observer rather than becoming an emotionally invested advocate. It keeps your decision-making process clean and rational. In essence, the circle of competence is a psychological defense system. It acknowledges that we are all susceptible to cognitive biases that can lead to disastrous financial decisions. Instead of relying on willpower to resist temptation in the heat of a market mania, It establishes a simple, powerful, rule-based system that protects us from our own worst instincts. To make this concept a practical tool, we need an applied mental model, a concrete exercise that any investor can perform. We can call it the 3 circles audit. This is a foundational exercise for developing an honest investment mindset and should be revisited at least once a year. It's about building your personal investment policy statement from the ground up. Step 1. Take out a large sheet of paper and a pen. In the center of the paper, draw a very small circle. This first innermost circle represents your core competence. Inside this circle, you will write down the businesses, industries, or asset classes that you understand so deeply you could confidently teach a university-level class on them. For most people, this circle will be very, very small. It might be based on your profession. An experienced software engineer might deeply understand the dynamics of enterprise software as a service companies. A career banker might understand the economics of regional banks. A lifelong farmer might understand agricultural commodities. Be brutally honest with yourself. This is not about what you find interesting. It's about what you have mastered through years of direct experience or intense study. If this circle is empty at first, that is perfectly fine. It simply means your work has just begun. Step 2. Around that small core circle, draw a larger second circle. This is your circle of learning. This area contains the industries or topics that you are actively and systematically studying. You don't have mastery yet, but you are following the personal MBA framework. You are reading the 10 kilosecond, studying the industry history, and building your knowledge base. Perhaps you've decided to learn about the insurance industry or consumer packaged goods. Listing them here is a commitment to the process of eventually moving them into your core circle. This circle represents your intellectual growth plan. Step 3. The entire rest of the page, everything outside the second circle, is your third and largest circle, the circle of avoidance. This is the entire universe of investments that you will not touch, no matter how exciting they sound. This will include complex derivatives, most biotech startups, speculative cryptocurrencies, and any business whose model you cannot explain simply. You are explicitly defining your ignorance. By writing this down, you are making a pact with your future self. You are giving yourself permission to say "I don't know," and to recognize that as a position of strength, not weakness. Once you have completed your 3 circles audit, it becomes your strategic map for all future investment decisions. When you hear a new idea, the first and only question you ask is, where does this fall on my map? If it's in the core competence circle, you can proceed with a deep, quantitative analysis. If it's in the circle of learning, your task is not to invest, but to intensify your study of that area. If it's in the circle of avoidance, the answer is an immediate and guilt-free no. This simple, visual model transforms a vague concept into a concrete, personalized rule for asset allocation and risk management. It forces the intellectual honesty that protected Buffett from the tech wreck and that will protect you from the inevitable manias of the future. It is the operating manual for staying smart by avoiding the easy ways to be stupid. The antithesis of this disciplined approach is what we can call the expert in everything, and it is the default mode for the 99% of market participants. The expert in everything is a dabbler armed with a dangerous dose of overconfidence. Their portfolio is not a reflection of a coherent philosophy or deep expertise. It is a chaotic, haphazard collection of the last half-dozen compelling stories they heard. This individual has an opinion on everything. On Monday, they are an expert on blockchain technology because they watched a documentary and believe a certain crypto token will replace the global financial system. On Tuesday, they are a biotech maven, buying shares in a company with a promising cancer drug based on a summary of a clinical trial they read online. On Wednesday, they are a geopolitical strategist, investing in an emerging market ETF because they heard a pundit say it was the next China. Their knowledge base is a patchwork of shallow narratives. They have no core competency. Their entire map is the circle of avoidance, but they don't know it. They believe they are diversified, but in reality, they have engaged in what Peter Lynch called diversification, the process of buying a collection of assets you don't understand, which provides the illusion of safety without any of the actual benefits of true knowledge-based diversification. The decision-making process of the expert in everything is driven by external validation, not internal conviction. They are constantly seeking the next hot trend, the next narrative that the crowd is chasing. This makes them exceptionally vulnerable to market manias. During the tech bubble, they were all in on tech. During the housing boom, they were flipping condos. During the recent crypto craze, they were minting NFTs. They are always late to the party and are usually the ones left holding the bag when the music stops. The most dangerous aspect of this approach is that it creates an illusion of sophisticated portfolio growth strategy. They might use fancy terms like satellite holdings or asymmetric bets to describe their speculative plays, but in reality, they are just gambling. Because they lack a deep understanding of any single asset they own, they have no basis for making rational decisions when things go wrong. A stock they own drops 20%. Is it a temporary setback for a great business or the beginning of the end for a flawed one? They have no idea. Their only recourse is to check the news, see what the crowd is saying, and react emotionally. This path invariably leads to a portfolio that underperforms the market over the long term, not because of bad luck, but because of a flawed process. The expert in everything is playing a game they cannot win, hopping from one area of incompetence to another, all while the disciplined specialist, operating calmly within their small circle of competence, steadily compounds their wealth and their wisdom. The direct financial connection of the circle of competence is one of the most powerful risk management tools an investor can possess. Its impact on your wealth is tangible, quantifiable, and profound, primarily through the dramatic reduction of unforced errors and the enhancement of conviction. First, it fundamentally alters your risk profile. For the expert in everything, risk is a vague, omnipresent fear. The biggest risks are the unknown unknowns, the factors they are not even aware of because of their superficial knowledge. For the investor operating within their circle of competence, the risk landscape is much clearer. They have done the work to understand the specific variables that drive a business's success or failure. This allows for a more intelligent and concentrated approach to asset allocation. Instead of spreading your money thinly across 50 companies you barely understand, the circle of competence encourages you to make larger, more meaningful investments in the 5 to 10 businesses you know inside and out. As Buffett himself has said, wide diversification is only required when investors do not understand what they are doing. A concentrated portfolio of high-quality, well-understood businesses will almost always outperform a scattered collection of speculative bets over the long run, and it is paradoxically lower risk because the owner understands the true risks of each holding. Second, this principle is the engine of beating the market. To achieve returns superior to a simple index fund, you must have a variant perception. You must see something that the market consensus is missing. This is virtually impossible if you are operating outside your area of expertise. However, within your small circle of competence, it becomes possible. Your years of specialized study in a particular industry allow you to spot nuances and opportunities that are invisible to generalist Wall Street analysts. This informational edge is your source of alpha. For example, the market may undervalue an industrial manufacturer because of a temporary downturn in the economic cycle, but because of your deep understanding of its competitive position and long-term contracts, you know its earnings power is intact and will rebound strongly. This gives you the conviction to buy heavily when the price is low, generating massive capital gains when your thesis proves correct. This conviction is the third and perhaps most important financial benefit. The deep knowledge that defines your circle of competence provides the emotional fortitude to act decisively during times of market panic. When the market is crashing, the expert in everything sells because they are scared. The specialist, seeing a world-class business within their circle of competence on sale at a 50% discount, buys with both hands. This single behavioral difference, buying fear and selling greed, is responsible for the vast majority of outperformance over an investment lifetime. The circle of competence isn't just a philosophical idea, It is a practical financial strategy that leads to a more concentrated, lower-risk, higher-conviction portfolio capable of weathering market storms and capitalizing on the irrationality of others. It is the blueprint for turning knowledge into a tangible and massive financial advantage. We have now established the what, the how, and the where of Buffett's learning philosophy. But there is a fourth pillar, without which all the knowledge in the world is useless. This is the temperament of a titan, conquering fear and greed. Buffett has famously stated that investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. Once you have adequate intelligence, what you need is the right temperament. This is the ability to control your emotions, to think independently, and to remain rational when everyone around you is succumbing to panic or euphoria. Knowledge tells you what to do. Temperament is what allows you to actually do it. The ultimate anecdote to illustrate this pillar is not a single investment, but Buffett's conduct during the darkest days of the 2008 global financial crisis. The fall of 2008 was a period of absolute, gut-wrenching terror in the financial world. Lehman Brothers, a 158-year-old institution, had just collapsed into bankruptcy. AIG, the world's largest insurer, was bailed out by the government. The credit markets were frozen solid. The global financial system seemed to be on the brink of total Armageddon. The Dow Jones Industrial Average was in a free fall, shedding hundreds of points day after day. The prevailing emotion on Wall Street and Main Street was pure, unadulterated fear. People were pulling their money out of the markets, hiding it in cash, convinced the entire system was about to implode. In the midst of this chaos, on October 16, 2008, Warren Buffett published an op-ed in the New York Times. The headline was simple and electrifying. "Buy American, I am." He began by stating a fundamental rule of investing. Be fearful when others are greedy, and be greedy only when others are fearful. He then laid out a calm, rational case. He acknowledged the terrible headlines and the very real fears gripping the nation. But he then zoomed out, reminding readers of the long-term resilience of the American economy. He wrote, "Over the long term, the stock market news will be good. In the 20th century, the United States endured 2 world wars and other traumatic and expensive military conflicts, the Depression, a dozen or so recessions and financial panics, oil shocks, a flu epidemic, and the resignation of a disgraced president. Yet the Dow rose from 66 to 11,497. He wasn't just talking, he was acting. Berkshire Hathaway was deploying billions of dollars. He invested $5 billion in Goldman Sachs and $3 billion in General Electric, not as a speculator, but as a lender of last resort, securing preferential terms that would become fantastically profitable. He was providing not just capital, but a vote of confidence in the entire system at the precise moment it was needed most. This was not a gamble. It was the ultimate expression of temperament. His decades of learning, his deep understanding of financial history, and his unwavering belief in long-term value allowed him to maintain his rationality while the rest of the world was losing its mind. He was not immune to the fear, he simply had a cognitive framework that was stronger than the fear. He knew that the price of a business and its underlying value were 2 different things, and that periods of extreme fear created the greatest opportunities to buy wonderful businesses at fire sale prices. While others saw only peril, he saw opportunity. This was the Titan's temperament in action, a potent combination of courage, patience, and rationality, forged over a lifetime of disciplined learning and emotional control. The psychological principles that Buffett demonstrated in 2008 are a direct counterassault on the 2 most powerful emotions that govern financial markets: fear and greed. These emotions trigger deep-seated, primitive cognitive biases that have been hardwired into our brains for survival, but which are disastrous in the world of modern finance. The primary bias triggered by fear is loss aversion. Pioneered by psychologists Daniel Kahneman and Amos Tversky, loss aversion describes the phenomenon where the pain of losing is psychologically about twice as powerful as the pleasure of gaining. Losing $100 feels as bad as gaining $200 feels good. During a market crash, this bias runs rampant. As investors see the value of their portfolio decline, the pain becomes overwhelming. The instinct is to make the pain stop, and the only way to do that is to sell. This leads to the classic mistake of selling at the bottom, locking in losses out of an irrational fear of losing even more. The second bias, driven by both fear and greed, is herd behavior, also known as social proof. Humans are social creatures. For millennia, our survival depended on sticking with the tribe. If everyone in the tribe started running, you didn't stop to ask why, you ran too. This instinct is still powerful today. In markets, it means we feel safest doing what everyone else is doing. When the herd is buying and prices are soaring during a bubble, we feel a powerful urge to buy too, FOMO, a form of greed. When the herd is panic selling during a crash, we feel an intense pressure to sell with them, a form of fear. The herd provides a feeling of safety, even if it's running straight off a cliff. Buffett's temperament is a cultivated, deliberate rebellion against these primal instincts. His approach is built on a foundation of independent thought. He has trained himself to use the market's emotions as a contrary indicator. When the herd is euphoric and greedy, his mental alarm bells go off. He knows that this is the time of maximum risk, when prices are likely detached from fundamental value. He becomes more cautious, more fearful. Conversely, when the herd is terrified and panicking, as in 2008, he sees it as a signal of maximum opportunity. He understands that widespread fear pushes the prices of excellent businesses far below their intrinsic worth. He actively cultivates the emotional strength to be the lone buyer in a sea of sellers. This isn't because he's a contrarian for the sake of being a contrarian. It's because his deep knowledge base provides an anchor of rationality that is stronger than the emotional pull of the herd. He trusts his own analysis of a business's value more than he trusts the manic depressive mood of Mr. Market. Cultivating this temperament is the highest level of the investment mindset. It's the final and most difficult step, moving from knowing what to do to actually being able to do it, especially when every instinct in your body is screaming at you to do the opposite. To develop this Titan-like temperament, we need an applied mental model, a set of practical tools to help us manage our emotions and make rational decisions under pressure. Two of the most effective are the pre-mortem analysis and the investment policy statement. These are core components of any serious wealth management strategy. The investment policy statement, IPS, is your financial constitution. It is a written document that you create during a time of calm and rationality, which governs your actions during times of emotional turmoil. Your IPS should clearly define several key things: your financial goals, e.g., retirement, education funding, your time horizon, and most importantly, your risk tolerance. It should then lay out your core investment philosophy. What is your asset allocation strategy? What are the specific, objective criteria you will use to buy a new investment? For example, I will only buy companies with a return on equity above 15% and a debt-to-equity ratio below 0.5, trading at a PE ratio below the industry average. Even more crucial, your IPS must contain specific, predefined rules for selling. For example, I will sell a stock if the fundamental reasons I bought it have changed for the worse, or if it becomes dramatically overvalued, exceeding a PE ratio of 40. It should not say, I will sell if the stock drops 20%. The IPS is your shield. When a market crash happens and the fear is palpable, you don't have to think. You don't have to listen to the pundits on TV. You simply pull out your IPS and follow the rules you wrote for yourself when you were thinking clearly. It outsources your discipline to your more rational self. The second tool is the pre-mortem analysis, a concept popularized by psychologist Gary Klein. Before you make any significant investment, you conduct this powerful thought experiment. Imagine it is 1 year in the future, and the investment has been a complete and utter disaster. It has failed spectacularly. Now, spend 15 minutes writing down every possible reason why it failed. Be creative and brutal. Did a new competitor emerge? Did the CEO turn out to be a fraud? Did a technological shift make their product obsolete? Was your initial valuation thesis simply wrong? This simple exercise does two incredibly important things. First, it forces you to confront the potential risks of an investment in a very real, tangible way, acting as a powerful antidote to confirmation bias. Instead of just looking for reasons why you're right, you are actively searching for reasons why you might be wrong. This often uncovers risks you had previously overlooked. Second, it psychologically prepares you for the possibility of failure and volatility. By having already imagined a worst-case scenario, you are less likely to be surprised or panicked if the stock price does drop. It depersonalizes the potential loss and allows you to assess market downturns more rationally, distinguishing between a temporary price drop and a genuine impairment of the business's long-term value. Using these two tools in tandem, the IPS as your strategic guide and the pre-mortem as your tactical risk assessment, creates a powerful behavioral framework. It helps to build the emotional calluses necessary to endure the market's inevitable swings and to act with the cool, calculated rationality of a titan. The antithesis to the titan's temperament is the emotional reactor, which describes the behavior of 99% of investors. The emotional reactor's portfolio is a direct reflection of their feelings from one day to the next. Their financial life is a symphony of fear and greed, played out in a series of ill-timed trades. The emotional reactor wakes up and the first thing they do, before even getting out of bed, is check their brokerage account on their phone. If the market is up, they feel a rush of euphoria. They feel smart, validated, and a little bit richer. This greed impulse might lead them to buy more of what's already going up, chasing the momentum. They are buying high. If the market is down, a cloud of anxiety descends over their day. They feel foolish and fearful. They check the account compulsively, every flicker of red deepening the knot in their stomach. This fear impulse often leads to panic selling. They sell not because the fundamentals of the businesses they own have changed, but because they can no longer tolerate the emotional pain of seeing their account value decrease. They are selling low. Their entire investment strategy is dictated by the daily mood of Mr. Market. They are a puppet, and the market's manic-depressive swings are pulling the strings. They are highly susceptible to narrative-driven investing. When the story around a sector is positive and filled with hype, their greed takes over and they pile in. Think of the dot-com boom or the clean energy craze. They don't do a deep analysis. They buy the story. When the narrative turns negative, their fear takes over and they flee, often right at the point of maximum pessimism. The devastating consequence of this behavior is that the emotional reactor systematically ensures they will underperform the very investments they own. There is a well-documented phenomenon in finance called the behavior gap. It is the difference between the reported return of a mutual fund and the actual return that the average investor in that fund receives. The fund might report a 10% average annual return, but the average investor in it only gets 7%. Why? Because they buy the fund after a period of good performance, buying high, and sell it after a period of bad performance, selling low. The 3% gap is the annual financial cost of their emotional reactions. Over a 30-year period, that behavior gap can consume more than half of their potential returns. The emotional reactor is their own worst enemy. All the financial education in the world is useless to them because, in the moments that matter, they abandon their intellect and allow their primal emotions to take control of their capital. They are playing a losing game, not against Wall Street, but against themselves. The direct financial connection of cultivating a titan's temperament is the closing of this very behavior gap. This is perhaps the single most impactful financial move an investor can make, and it translates directly into hundreds of thousands or even millions of dollars in additional wealth over a lifetime. Let's quantify it. Imagine two investors, Investor A, the titan, and Investor B, the emotional reactor. Both start with $100,000 and invest in the same S&P 500 index fund which will assume returns an average of 10% per year over 30 years. Investor A, the Titan, has a strong temperament. They use an investment policy statement, ignore the daily noise, and simply buy and hold, rebalancing once a year. They capture the full 10% market return. After 30 years, their initial $100,000, without any additional contributions, grows to approximately $1.74 million. Investor B, the emotional reactor, is subject to the behavior gap. Let's be conservative and say they're emotional trading, panicking during crashes, getting euphoric during bubbles, costs them just 2% per year. So they earn an 8% annual return instead of 10%. After 30 years, their initial $100,000 grows to approximately $1 million. The difference is over $740,000. That is the direct, quantifiable financial cost of a poor temperament. It is a massive emotional tax levied on their wealth year after year. Furthermore, a strong temperament turns market volatility, which is a source of loss for the reactor, into a source of profit for the Titan. The 2008 crisis provides a perfect example. The reactor sold their stocks near the bottom in early 2009. The Titan, following Buffett's lead, was rebalancing their portfolio, selling their safer bonds, and buying stocks at generational lows. The reactor locked in devastating losses. The Titan seeded their portfolio for the next decade of spectacular growth. The financial result is not just a slightly better return, it's a completely different stratosphere of wealth creation. The reactor's portfolio experiences sawtooth growth, 2 steps forward, 1.5 steps back. The Titan's portfolio experiences true, uninterrupted compounding. This temperament is what allows you to hold on to your big winners. The reactor buys a great company, it doubles, and their greed/fear makes them sell to lock in the profit. The Titan, understanding the business, holds on for decades, allowing a single great investment to grow 10, 20, or even 100-fold, creating true generational wealth. The ultimate financial connection is this: your long-term returns will be a reflection not of the cleverness of your strategy, but of the discipline of your behavior. Investing in your temperament, in building the emotional resilience to stick to your plan, pays a dividend that is larger, more reliable, and more impactful than any stock you will ever own. This brings us to our fifth and final pillar, the culmination of all the others. This is where the intellectual and the temperamental are fused into tangible action and lasting wealth. This is the perpetual dividend, how lifelong learning pays you forever. This principle posits that the ultimate goal is not just to make smart investments in the market, but to transform yourself into the primary asset, a learning machine whose insights and decisions generate a continuous stream of returns, a dividend that can never be cut. The quintessential story to illustrate this is Buffett and Munger's 1972 acquisition of See's Candies. On the surface, it seemed like a strange purchase for a brilliant financial mind. See's was not a high-tech company or a complex financial firm. It was a simple, family-owned box chocolate company based in California. The asking price from the See family was $30 million, but Buffett and Munger's initial valuation, based on the company's tangible assets like inventory and factories, was much lower. Their traditional deep-value cigar-butt investing framework, learned from Ben Graham, suggested the price was too high. A younger Buffett might have walked away. But this is where decades of learning paid off. Buffett had evolved. He had been learning from his own mistakes, like his earlier purchase of Berkshire Hathaway itself, a struggling textile mill with heavy assets. He had been learning from Charlie Munger, who was pushing him to understand that it was better to buy a wonderful business at a fair price than a fair business at a wonderful price. He had been learning from his observations of companies like Disney and Coca-Cola. This cumulative knowledge created a new lens through which he could view the See's Candies business. He saw something that wasn't on the balance sheet, an incredible, unassailable brand. See's had a powerful moat built on decades of customer loyalty, nostalgia, and a reputation for quality. In the mind of the consumer, especially during holidays, giving a box of See's chocolates was a social ritual. This brand loyalty gave See's immense pricing power. They could raise their prices a little bit each year to cover inflation and then some, and their customers would happily pay it. This meant the business required very little new capital to grow. It was a cash-gushing machine. Buffett realized he wasn't just buying factories and inventory, he was buying a piece of his customers' minds. This insight, born from a latticework of mental models from business, psychology, and personal experience, allowed him to see that $30 million was actually a bargain. They paid the sellers final price of $25 million. See's Candies went on to generate over $2 billion in pre-tax earnings for Berkshire Hathaway over the next several decades, all while requiring minimal additional capital investment. But the story doesn't end there. The true perpetual dividend was how the lessons from See's informed every subsequent Berkshire investment. The cash generated by See's was used to buy other wonderful businesses. More importantly, the mental model of a high return on capital branded consumer products company with pricing power became a cornerstone of the Berkshire Hathaway acquisition philosophy. It helped Buffett understand the true value of Coca-Cola, Gillette, and later, Apple. The initial investment wasn't just in the candy company. The real investment was in the decades of learning that allowed Buffett to recognize its quality. And the perpetual dividend was not just the cash from selling chocolates, it was the powerful, repeatable insight that he could apply for the rest of his life, an intellectual asset that appreciated in value with every new experience. The psychological principle underpinning the idea of the perpetual dividend is the creation of what Charlie Munger famously calls a latticework of mental models. This is the pinnacle of the learning process. It's the idea that to truly understand the world and make effective decisions, you cannot rely on the narrow framework of a single discipline. You need to collect and internalize the big, foundational models from a wide range of fields: psychology, biology, physics, history, and economics, and allow them to interconnect in your mind. The human brain has a natural tendency towards what Munger calls man with a hammer syndrome. To a man with only a hammer, every problem looks like a nail. If you're an economist, you try to solve every problem with supply and demand curves. If you're a psychologist, you see everything through the lens of cognitive bias. This narrow view of the world leads to massive blind spots and poor decision-making. The latticework approach is the antidote. It's about building a versatile intellectual toolkit. When you learn about the concept of autocatalysis from chemistry, where a reaction's product is also its own catalyst, you suddenly have a powerful model for understanding the viral growth of a social media company. When you learn about redundancy from engineering, the practice of building backup systems, you have a new way to think about building a margin of safety into your portfolio. When you study natural selection from biology, you gain a framework for understanding how industries evolve and how only the most adaptable companies survive over the long term. Lifelong learning, in this context, is not about cramming more and more facts into your head. It's about collecting more and more of these powerful universal models. Each new model you acquire is another node in your mental latticework. The true magic happens not in the nodes themselves, but in the connections between them. This is how you generate unique insights. When Buffett analyzed See's Candies, he was using a model from psychology, brand loyalty and social proof, and combining it with a model from economics, pricing power, and a model from finance, return on invested capital. The synthesis of these different models created an insight that was unavailable to the single-minded analyst just looking at the balance sheet. This process of building a latticework creates a virtuous cycle. The more models you have, the more new information you can hang on the structure, making your learning more effective. And the more connections you form, the better your pattern recognition abilities become, which improves your decision-making. This is the psychological engine of the perpetual dividend. You are no longer just a stock market investor. You become a multidisciplinary thinker, a business analyst who can see the world with a clarity and depth that is simply inaccessible to the narrow specialist or the shallow dabbler. Your brain itself becomes the compounding asset. So how do we apply this and build our own latticework? The mental model for this is the learning flywheel. A flywheel, in mechanics, is a heavy wheel that takes a lot of effort to get spinning. But once it's moving, its momentum helps it to keep turning with less and less effort. The learning flywheel is a self-reinforcing loop that accelerates your competence and your returns over time. It consists of 4 distinct stages. Stage 1 is learn. This is the deliberate acquisition of a new mental model from outside your core discipline. Make it a habit to read broadly. If you're in finance, pick up a book on evolutionary biology. If you're a doctor, read a biography of a great military leader. The goal is to hunt for the big, timeless ideas. For example, you might read about the concept of social proof in Cialdini's Influence and understand how people look to others to determine their own actions. Stage 2 is apply. You must immediately take this new model and use it as a lens to analyze a real-world situation, preferably a business or an investment. You could look at a company like Lululemon and analyze how much of its success is driven by the social proof created by its army of devoted followers. This active application takes the model from an abstract idea to a practical tool in your analytical arsenal. Stage 3 is decide and act. Based on your analysis, you make a decision. This doesn't always mean buying or selling. The decision could be to do nothing, to continue watching, or to dig deeper. The key is to make a conscious choice based on your model-driven insight. For instance, your analysis of Lululemon's social proof moat might give you the conviction to buy the stock during a temporary market downturn. Stage 4 is feedback and refine. This is the most important stage. You observe the outcome of your decision and, critically, you analyze why it happened. If your Lululemon investment did well, was it because your thesis on social proof was correct? Or did you just get lucky with a rising market? If it did poorly, where was the flaw in your application of the model? This feedback loop, both from the market and from your own self-assessment, refines your understanding of the mental model. It might teach you the limits of social proof or how it interacts with other models like competition. This refined understanding then feeds back into stage 1, making you better at learning and applying the next model. At first, turning this flywheel is hard work. Your initial learning is slow, and your applications are clumsy. But with each rotation, it gets easier. Your lattice work becomes denser. The connections form faster. Your insights become sharper. Your decisions become better. This is the ultimate engine of self-improvement and personal development. It creates an accelerating loop of competence. The perpetual dividend is the output of this flywheel in motion, a continuous stream of better decisions, not just in your portfolio, but in your career and your life, driven by an ever-expanding, ever-compounding latticework of wisdom. The antithesis of the learning flywheel is the path of the 99%, the stagnant learner, or the one-trick pony. This is the person who believes that their education ended when they received their diploma. They go to work, they do their job, but they are not engaged in a deliberate process of self-improvement. Their knowledge base, which might have been sufficient at the start of their career, begins to depreciate over time, like an unmaintained piece of machinery. The stagnant learner in the world of investing is particularly vulnerable. They might have found a strategy that worked well in one market environment, for example, buying fast-growing tech stocks in the bull market of the 2010s. This becomes their one trick. They are the man with only a hammer. They believe they have found the secret to the market and stop learning. But markets are not static. They are complex adaptive systems that are constantly evolving. The economic environment changes, new technologies emerge. The strategies that worked in one decade often fail spectacularly in the next. When the market environment shifts, for instance from a low interest rate growth environment to a high interest rate value environment, the one-trick pony is completely lost. Their single tool is no longer effective. They keep trying to apply their old strategy, but it no longer works. Their portfolio suffers. Instead of questioning their own model, they often conclude that the market is broken or rigged. They lack the intellectual agility that the learning flywheel provides. They cannot adapt because they have not been actively acquiring new mental models. They are the dinosaurs, waiting for the meteor of market change to arrive. Their knowledge is not compounding, it is decaying. This is a subtle but devastating form of financial risk. The world is moving forward, and they are standing still, which means they are effectively moving backward. The stagnant learner might maintain their career and their savings for a time, but they are building their financial house on a foundation of intellectual sand. Without the continuous reinforcement and expansion of their knowledge base, they are one market paradigm shift away from a catastrophic financial setback. They are not receiving a perpetual dividend. They are slowly but surely liquidating their most important asset, their own human capital. The direct financial connection of becoming a lifelong learning machine is the ultimate transformation in personal finance. It is the shift from thinking of your portfolio as your primary asset to understanding that you are the primary asset. Your ever-growing human capital becomes the engine that drives all your financial success. This manifests in several powerful ways. First, it maximizes your earning power in your career. The same learning flywheel that makes you a better investor makes you exponentially more valuable as an employee, executive, or entrepreneur. By constantly acquiring new skills and mental models, you become an adaptable problem solver, capable of adding value in ways that your stagnant peers cannot. This leads to promotions, higher salaries, or more successful business ventures. This increased income is the fuel for your investment portfolio. For most people, the amount of money they are able to save and invest over their lifetime will have a far greater impact on their final net worth than their specific investment return percentage. A lifelong learner maximizes this crucial input. Second, it creates a truly adaptive and resilient wealth management strategy. The stagnant learner is destroyed by change. The lifelong learner thrives on it. By building a latticework of mental models, you are not tied to a single strategy. You can analyze and adapt to new asset classes, new technologies, and new market regimes. When the world changes, you are not a victim. You are an opportunist, equipped with the intellectual tools to understand the new landscape and position your capital accordingly. This adaptability is the key to building generational wealth that can survive and prosper through the inevitable cycles of creative destruction. Finally, the perpetual dividend is the achievement of a state of true financial freedom that is not dependent on the whims of the market. Your knowledge, your process, and your temperament become a source of intellectual income that is far more reliable than any stock dividend. It is the ability to generate your own alpha through superior thinking. It is the confidence that comes from knowing you can analyze any situation and make a rational, well-informed decision. This is a form of wealth that can never be taken away from you in a market crash. The market can take your money, but it cannot take your wisdom. This is the final promise of Warren Buffett's greatest investment. By investing in yourself first, by committing to the path of lifelong learning, you build an internal compounding machine that pays you a perpetual dividend of better decisions, greater adaptability, and unshakable confidence. Your portfolio's growth becomes a byproduct, a mere reflection of the ever-increasing value of the true asset, your own mind. You have made it through a deep and rigorous exploration of what may be the single most important principle in building lasting wealth. You have pushed past the seductive noise of hot tips and easy answers to grasp the foundational truth that has guided the most successful investor in history. You now possess the mental model that separates the 99% who dabble and fail from the 1% who study, understand, and build fortunes. You understand that you are your own most profitable asset, and that the highest return on investment comes from the relentless compounding of your own knowledge. This is a powerful, life-altering shift in perspective. But understanding this core philosophy is only the first, foundational layer. It is the why. Buffett's true genius, the operational brilliance that built Berkshire Hathaway, lies in how he connects this philosophy of lifelong learning to a vast and interconnected latticework of specific, actionable mental models for execution. Models for valuing a business with precision, for assessing the quality and integrity of management, for understanding the deep structures of market cycles, and for allocating capital with ruthless rationality. Knowing you must invest in yourself is the key that unlocks the door, but on the other side of that door is an entire arsenal of intellectual tools waiting to be mastered. The video that is now appearing on your screen is not a random suggestion from an algorithm. Think of it as the next piece of that arsenal. It is the bridge from the why of learning to the how of execution. It holds the next model in the sequence, the specific technique that links the philosophy you've just mastered to the tangible decisions you must make in the market. The average person will feel inspired now, and that inspiration will be enough. They will click away, content with the principle, but will fail to acquire the tools for its application. But you are not the average person. Your journey here proves you are part of a smaller group, the ones who are not just seeking inspiration, but are committed to building a complete intellectual fortress. The choice to click is not about watching another video, it is a declaration. It's a conscious decision to continue your ascent, to add the next weapon to your mental arsenal, and to continue the disciplined work of transforming yourself into the kind of investor who does not hope for success, but engineers it. The map is in front of you. Complete the next step.